Good morning, good morning, good morning. How's everybody doing? Cash flow and profit, very important, right? We're not buying real estate to lose money. We want to know how much profit we're going to make. It's not worth the $20,000, right? But if we can buy it and then sell it the next day and make $20,000, that $20,000 is not that bad.
There's so many intricacies of a deal, so many different ways to work it and add value. The more you know, the more you can capture value on one end. Hey, Mr. and Miss Seller, we'll pay you double the value of the property, but you work with us up front and you can make a trade-off there.
And this is where the creativity, being able to think strategically, go into these negotiations, into these conversations, and use the entrepreneur method. Everything we talked about yesterday and everything we're going to do live today is really important. Welcome to another Monday of going live. We need to figure out a name for these. We should call them. I don't know. Drop a comment in the on Facebook, YouTube, Instagram on what we should call these lives every Monday. Real estate Mondays, Monday real estate. All right, but today we're going to be talking about deal requirements within your commercial real estate deals or any deal that you're doing. You should be looking for a few things, and you should not do deals that don't meet these requirements. And we may try and pull up something and see if we can find a deal here live with you guys. But thank you for joining. This is Mondays where we talk about real estate investing. If you don't know, my name's Alex Kaufman, and me and my partner Matt have built TRE. We are real estate investors. We own, I don't know the number, $45 million real estate portfolio. We bought a bunch of single family homes, duplexes, triplexes, quadplexes with our partners, small commercial deals. We have a couple partners that we raise capital with and buy deals with, and a lot of partners that buy real estate with us. We have some retail shopping center property. We have mobile home park. We're under contract to buy a big RV park right now with our partners and investors. And so we co-live here today and every Monday at noon CST, so that hopefully we can teach you something, hopefully encourage you to get out in your market and start doing deals. But we love real estate. Real estate is the best asset that I've ever invested in. Invested in stocks and cryptocurrency and other things. That my own business and real estate, which is also our own business, are the best investments that we've ever made. So we hope to share some stuff with you here today and every Monday that hopefully helps you out on your journey. But anyways, today we're going to be talking about deal requirements. There's a few things that you need to stick to when you're looking for deals. There's a lot of real estate out there that you can buy, but it doesn't mean that it's good real estate. You're looking for good real estate, good deals that are going to bring you money, bring you wealth, bring you cash flow, and secure your future. Are we doing good on? All right. We usually have audio problems on these lives, but I think we're doing fine today, so that's good. So anyways, you want to buy good deals, and you need to stick to the rules, right? You can't just go out there and buy anything that's listed on the market. That is not the way to approach investing in real estate. You're looking for a few things. There's only a few deals out there. You're going to look at 1,000 deals, and you're going to hopefully only buy, a few of those deals, because the rest don't meet these requirements. The sellers might not be where they need to be at yet in order to sell the property at a price that makes sense for somebody else. And you want to let all the other suckers out there go out and buy the okay deals, but you want to buy the home runs and the deals that are truly going to change your life. So that's what we're going to talk about here today, is the deal requirements that you must stick to. Number one is opportunity. Never buy a deal that doesn't have opportunity, right? That's the whole reason you're buying it. If the opportunity has been maxed out, if the city and the location it's in has no opportunity, if there's no way to raise the income on it, if it's just an average deal and there's not an opportunity with the deal, you want to stay away from it. Opportunity is how you're going to make your money. Opportunity is how you're going to build your wealth. Getting in there, buying something below valued, seeing something else, seeing something in a property that somebody else didn't see, going in, executing your business plan is how you're going to make a lot of money investing in real estate. So it must have opportunity. The second thing that it must have is value. Somebody once asked, what's the difference in value and opportunity? And when they asked, it was a good question. When they asked, I didn't quite have an answer for it. But the difference between value and opportunity is the value is what you're going to go in there and create, and the opportunity is that of the value. The value is what you're going to do to the property, it's the business plan, and the opportunity is the opportunity to be able to go in there and execute on that value increase. So, value, you're looking for a way to increase the value of this property. If you're buying a single family home, a duplex, a quadplex, the way that you can increase the value of those properties is by maybe renovating the units, maybe raising the rents on them if they're not already at market. But the real value of those properties is going to be dependent upon what the other duplexes and quadplexes are selling for in that neighborhood and in that area and location. Like in Austin, Texas, for example, if you want to buy a duplex in Round Rock, you're looking to pay about 400 grand. In 2020, they were breaching higher levels. Right now, depending on when it was built, what condition it's in, if it's a 3-2 or a 2-1 unit mix, you're looking between probably 375 to like 450,000 dollars on the higher end. But I mean, you're not going to go buy this duplex and then all of a sudden next year it'd be worth 800. You are you're stuck based on the market conditions. Now, Austin would have to appreciate, or Round Rock would have to appreciate the price of duplexes, 100% in order for you to gain, a value of 800 grand on a duplex next year. But with commercial real estate, you can create that value by increasing the income. And that is what you're looking for. You don't want to go into something where the value's already been created and there's no room for you to create, to add value and increase the value of this property. And that is the opportunity. So it could be different things, right? Like with our shopping center, there were a few different ways that we were able to go in there and add value to it. So first and foremost, um, we were able to get long-term leases signed. So the tenants were all on annual leases, which was actually a good thing. That was the opportunity, was that the tenants were all on annual leases. Now that presented an issue with the bank in getting a loan because the banks wanted longer-term leases. But we were able to go in, execute our business plan, get some LOI signed in order to be able to get a loan on the property for the tenants to renew at longer term leases. But the opportunity was the fact that they had short-term leases signed. The property had a little bit of deferred maintenance. I mean, not a whole lot. The property's in really good condition, but the landscaping wasn't the greatest. The signage wasn't the greatest. It needed a new roof. So we're going to execute improving the property by doing those things. The other opportunity was being able to raise the NOI. In the way that we did that, and we created value by raising the NOI, is we got the longer term leases signed at about a 30 to 40%, depending on the tenant, rental increase based on the current rate they were paying. So instantly, the moment they sign these leases and are paying the higher rates upon renewal, the value of that property just increased by 40%, right? So that is what the value is. That's what you're looking for. Those are the types of opportunities that you're looking to seize You're not looking to go buy something and it be worth the same thing, that you bought it for a year and a half, 2 years later. You want to seize the opportunity. You want to add value, and that is where your wealth and value creation is going to come from. Number three, uh, you want to buy into equity day one. I'm not just talking about your down payment. You don't want to pay market value for something. You want to go in here a good return on the deal day one, make all your money on the buy. That way, if you're not able to seize the opportunity, if you don't create any more value, you have at least made some sort of return by buying the property correctly. And you're also protecting yourself against the downside in case the market shifts. But don't overpay. Don't pay market value. A lot of people who uh, are overpaying for deals in 2020, 2021 are in real hot water. Matt and I were talking about that this morning. I asked him if he knew what a couple guys, if he's heard from a couple guys that were doing deals around that time, raising capital and like building apartments and doing multifamily deals here and Austin. And he said that he hadn't uh, he hadn't heard anything about them or from them, and who knows if they even still have those properties. But they probably overpaid for those deals. They probably, uh, you know, did not follow these deal requirements, or the deal requirements were a little bit cloudy. And in 2020 and 2021, it was really easy for people to justify taking the extra risk because the market was crazy. There's a lot of FOMO, fear of missing out. If I don't do this deal, somebody else is going to do this deal. Well, that's probably true, but just because there's a lot of suckers out there doing things doesn't mean that you have to do them. So, don't be monkey see, monkey do, right? What you need to do is stick to this and always make sure you're getting equity day one in some way, right? Even if the property, like the shopping center example, it was appraised at 2.7. We bought it for 2.45, so there's a little bit of equity in there, but I mean, not a whole lot, But what really happened was, this part right here is where we really secured that equity. We probably bought it about $1 million below what the property would be worth the moment somebody would go and do this, right? So you want to secure that equity day one. You don't want to overpay for it, and um, you don't want to get risky. Number four, multiple. We have any questions, Kat? You don't have any questions? You need to have multiple exits. So with multiple exits, you're looking for different ways that you can get deals done. I was thinking about this morning, about different types of real estate assets, whether it's Airbnb, maybe assisted living, uh, maybe another type of real estate asset that is highly specialized and works with a certain type of a business plan, which is ultimately not long-term real estate. It's hospitality or nursing or something along those lines. But when you have when the only way for a deal to make sense is for it to happen this one way, if that one way doesn't work out for whatever reason, you're screwed. And so you never want to buy a deal where there's only one way to make it work, right? Because it never works out exactly the way that you think it's going to. Ever. I've never bought one deal that worked out exactly the exact way we thought it was going to. There's always something that comes up along the way. There's always things you got to address, always things you got to handle. And you always want multiple exits on how to get out of this deal or how to make this deal work in case plan A doesn't happen the way that you want it to, right? So whether that is, uh, like for example, the RV park we're buying right now. Um, the property produces a good return as is today. If we didn't do anything to the park, if we didn't work on raising rents at all, if we did not add more amenities to the park, if we did not restructure the website, if we didn't dial in the marketing, if we didn't do anything to the park, as is today, the property is going to produce a good return and does very well. Now, that's backup plan. That's worst case scenario. We don't touch anything and we leave it as is. It's still going to do well and produce a good return. Now, a lot of that has to do with one of the ways that we negotiated this deal by structuring 0% seller financing terms. I mean, even if we made $0 a month for 5 years, we would gain close to over 100% on our money because of the 0% seller financing terms. Principal pay down would be over 100% than our down payment for the next 5 years. So without doing anything, without making any other money, simply by paying down this principal, we would gain uh, over 100% in equity based on the capital that we're having to put into it as a down payment. So that's absolute worst case scenario. Now, what we are going to do is we're going to add more amenities, we're going to add more slots, we're going to improve the marketing, we are going to improve the occupancy, we're going to raise the rents, and we're going to manage this property more effectively. Now, when the execution of doing that is where the opportunity and the value is, as well as the value in the seller financing. We do have equity day one, and we have multiple exits. We have different ways that we can attack this thing. If plan A doesn't work for whatever reason, it's still an insane deal based on the deal that we negotiated. So always have multiple exits. With the Airbnb property, like if you go out and buy an Airbnb and you overpay for it and it's got this extremely high payment, and the only way to make the deal work and to get cash flow and a return is by Airbnb-ing it out. If Airbnb goes away and short-term rentals slow down, or people stop traveling, or there's new HOA rules, or whatever the case is, if that doesn't work, then you're screwed. So you don't want that being the one exit. You need to have different opportunities and different exits to make the deal work, just in case something goes wrong. All right, do we have more paper here? Number 5. Location. I have I've learned this more and more through the years of investing in real estate. Uh, I've learned this more and more. So we've always bought in Austin, Texas. I mean, this is where we're born and raised. This is where uh, deals have been that we've bought over the years, has been here in this Central Texas, Austin, Texas market. So it's really the only location that we've had to focus on. We weren't buying in bad markets to begin with. We've always started with a great location and a great market. Um, but uh, looking at deals, it's easy to get, and I understand this, and I think that a lot of people probably feel this way. Like today, we were looking at a deal, um, or we were talking to the broker on a deal here in Austin, where is a RV mobile home park, 193 units, I think. And there's not many parks that size around here in Austin. Uh, and they're wanting to sell it near a 5 cap, and it's Austin. I mean, that's just the price. I guarantee that they'll probably get close to that. Uh, Even though it's just dirt for the most part, you're buying the income. You're not buying an apartment complex. You're not buying something like that. But it's Austin, and I guarantee you though that property, paying that price in a good location in Austin, will do better than paying for an 11 cap in some random city with population of 1,000 people, and you decide to buy that deal because it is cheaper, right? Cheapest is not best, ever. Name one thing in this world where cheapest is best, and I will gladly admit that I'm wrong. But I've never found anything in this world where cheapest is best. I'm not saying most expensive is best either, but there's a reason why good locations are priced the way that they are, and it's because they're good locations. It's because they got a ton of demand. It's because the tenant base will always be there. It's because the jobs are moving there. It's because people want to be there. Because you'll always have somebody who wants to buy this thing from you. You're always going to be able to raise the rents in a good location and in a good market. People will always want to own this piece of real estate. You don't want to own real estate that nobody else wants to own. That's pointless, and it's going to be very hard for you to get rid of. So you want to buy in a good location, and the reason I'm talking about all of that is, at first, I'm sure a lot of people looking at this RV mobile home park in Austin at a 5 cap would think that it's too expensive, but it's Austin, and there's always going to be somebody who wants to pay more for that. And let's just do some math real quick. I don't know what all the financials are on it, but let's see here, if you're able to raise the NOI on this thing by, I don't know, 293 units. Let's do some math. 293 times, let's say $150. If you raise the rent over a couple of years by 150 on 293 units in the city, here's the other thing about this park is that you're not going to go build more mobile home parks in RV parks. We own a mobile home park that's quite a bit smaller than this one in Austin. It's 30 minutes from downtown, 3 minutes from the airport. Insane location. But the neighborhood around this mobile home park has been trying to shut us down for years. Before we even bought it, they were trying to shut down the previous owner. They don't want a mobile home park in their neighborhood. This is a great location, a great area. You can't go build another one necessarily. The barriers to entry of having a 293 slot RV/mobile home park in Austin is high. Uh, there's not going to be more of them. So that's the other thing. But if you just raise the rents by $150 and it's always going to stay full. I mean, affordable living in Austin for a RV/mobile home park, these people are never going to want to leave. I guarantee it'll stay 100% occupied at all times. So, $150, 293 units is an additional $527,000 in NOI. I don't know if this is possible on this one or not, but if you do that, you just added $10.5 million worth of value at a 5 cap by raising the rents on these by $150. So that's why it is the price that it is. You'll never make that money on the 11, 12, 13 cap in a city worth of, with a population of 1,000 people. No one's going to want to buy it from you. There's always going to be some sucker out there who wants it, but you're not going to have the demand to pay and overpay for a property like you will in Austin. So you have to have a good location. It's extremely important. I've learned this. Uh, I've learned this over the years doing it, and we've always focused in on markets such as Austin. But as we explore out, start looking at different locations to invest in, I start to understand how important it is, to invest in a location such as Austin, Texas. Go ahead. What?
Someone said they get seller finance properties, but what about assuming the seller's loans they get to whoever they don't?
Yeah.
And then
Speaking in the mic so people can hear you.
I'm curious what your
Well, hold on. It's dead noise here. Someone asked if we ever buy properties subject to, and the answer is yes, we have. And I prefer seller finance deals. That RV park that I was just talking about, there's an opportunity for seller finance on it. But the RV park that we're buying in Dallas, seller finance. So that's part of the debt that you need that I'm going to get to here in a second. But yeah, we buy properties subject to and with seller financing. And the next one,
The next question is, what's better, a higher or lower cap rate? Google says higher means more return but more risk. Lower is safer, question mark.
yeah, correct. It's not better, right? What you need to focus on is not cap rate. You need to focus on these deal requirements that I'm teaching you. Number one, opportunity, value, equity, multiple exits, location, and I'm about to get through the remaining four. But a cap rate is just a percentage. It's a ratio of two numbers: what you pay for something and what the NOI is, or what the value is and what the NOI is. That's all a cap rate is. It doesn't mean that one's better or worse, but you need good locations. You need opportunity, value, equity, multiple exits, location. Number six, you need investor demand. This is what you need to focus on, is not what cap rates you should buy. You need to focus on these deal requirements. But if you're buying in good locations, in the best locations, the cap rates are going to be lower. If you're buying in that random city in Texas that has 1,000 people who live there, your cap rate's going to be higher. It's because no one wants it, so it's a cheaper property. But here, in the great locations, everybody wants it, so the price is higher. Cap rate, I don't want to dive deep into cap rates today, but NOI, assuming NOI remains the same, cap rate and price have an inverse relationship. So if the price is higher, that means the cap rate's lower. If the price is lower, it means the cap rate's higher. But that doesn't mean just because it's a 5 cap or just because it's an 11 cap doesn't mean it's a good deal. These deal requirements are going to tell you if it's a good deal or not. What is the opportunity and the value? That's going to tell you if it's a good deal or not. How much money are you locking in day one? That's going to tell you if it's a good deal or not. Do you have multiple exits? That's going to tell you if it's a good deal or not. How good is the location? That's going to tell you if it's a good deal or not. Investor demand and the things that we talk about here in a second are going to tell you if it's a good deal. But the reason that the cap rate is higher for that random property in that random city that nobody wants is nobody wants it. And nobody's ever going to want it. And that's why you don't want to buy it either. You don't want to be the sucker who buys the things that nobody wants. You want to own the supply of things that people have a lot of demand for, not the other way around. So investor demand. This is referring to like any of these properties. You want to buy something that other people want, just like I was just talking about. So if I control this deal and I know that I got 10 other people, 10 other investors who would love to take this deal off my hands today, higher than the price that I got it locked up at because of all these things we're talking about, that is a requirement. I need to buy things that other people want. You don't want to own real estate that nobody wants to buy. You're the only one who wants to buy it. You're going to hold on to it forever, and it's not going to produce anything for you. You want things that other people want to buy. You want to buy real estate that other investors are willing to pay a higher price for the same day that you buy this property. That means that you have value. It means you control the supply of something where there's a lot of demand, and so that's what you're looking for. Next is cash flow. Unless you're flipping something, which now is not the time to do that. But unless you're flipping something and you're buying something to buy and hold, you need cash flow. It will destroy you. Uh, you may be fine losing $100 on a single family house every month for a while, but it's impossible for you to scale. If you have 100 of those and you're losing $100 a month, that means you're losing $10,000 a month is going out of your pocket and going into these properties. You need cash flow on deals that you're going to buy and hold. And that cash flow needs to be sufficient. And that's the reason why we're focusing on these bigger and better deals is the smaller ones, they'll never have cash flow with debt. So you can get cash flow on them, but you have to buy these properties cash. And in either scenario, uh, you can't scale unless you're BlackRock and you've got trillions of dollars and trillions of assets. You will not go out and scale a single family portfolio and be happy with it. I guarantee it. We've tried, and we're trying to get rid of ours. I want to sell the portfolio and go buy bigger and better deals that have all these things we're talking about. Now, the portfolio was doing great in 2020, 2021, when the values were increasing 20%, 30%, 40%. We were gaining insane amounts of equity, but uh, not anymore. The market's not appreciating like that. They never cash flowed. The rates are crazy today. We lose money on the single families, but we do have a good amount of equity in them. But it's going to kill you. You need to have cash flow on the deals that you're buying if you're going to buy and hold these. And I'm only telling you this because we've been through it. I'm not just sitting here and making this shit up. I'm telling you because we've been through it. I own a lot of them, and they suck. They're not a lot of fun. They steal from you every single month, and there's no scale to it. So if you just want to own one or two or five of them, maybe that's the way to go. But if you want to own 2,000, 5,000, 10,000 units and buy a ton of real estate, don't go that route. Just I'm saving you time and energy and headache and emotional energy. Just go buy big deals that meet all these requirements. And if you need help, if you need a partner, if you need partners, if you need more resources, reach out to us. That's what we do. We haven't always had everything in place. We had to go out and find people to do things with. So you should do that as well if you don't have it. All right, great cash flow. Number 8 is financing. Buying real estate cash, just like we were just talking about, there's no scale to it, and also your returns are much they're diminished. Your returns are maximized and amplified when you use financing and you get debt on real estate. It's a beautiful part about real estate. You don't have to have all the money to buy it. If you wanted to go buy $100,000 worth of Apple stock today, you would have to go and put in $100,000 and trade your $100,000 for $100,000 worth of shares. If you wanted to go buy $100,000 worth of real estate today, if it was a good deal and met all these requirements, you'd put down 15, 20, 25,000, and then you would secure a $100,000 asset. So you want to get debt, but it needs to be good financing. All financing is not good financing. All debt is not good debt. You need good debt, long-term fixed debt, or seller finance deals that you can structure. You don't want to go get in short-term debt with high interest rates on a deal you're trying to hold on to if you're unsure how you're going to get out of it. Maybe you have to secure it with hard money or bridge debt initially, but I would recommend not doing it. If you're buying good deals that have all these things, you shouldn't need to go get hard money and bridge debt anyways. It'll qualify for the best debt that you can get because the banks want to lend you money on those assets because they make money, right? So you need great financing. It's going to help you scale. It's going to maximize your returns. You're going to make more money doing it. There's better tax advantages when you're using debt, but make sure you get good debt. So the deal has to support great debt. Number 9 is really important. Oops. You need a great management team. If you buy a good deal And this all really kind of works together. If you're finding good deals in good locations with a lot of these things, it really all kind of works together and meets all these requirements, right? When you're in a bad location, you're not going to have good management. When you're in a good location, the likelihood of you being able to get a good manager to manage the deal is much higher. For the RV park that we are buying right outside of Dallas, by the way, great. I'll run through all these things with you to show you how it meets all these deal requirements. But the RV park that we're buying uh, has a good management team, good on-site manager, and good on-site maintenance staff. But I've probably had like 400 people apply for that job because it's outside of Dallas. If I posted that uh, for a position at a RV park in you know Alice, Texas, I don't know, maybe I have 2 to 3 people to choose from, but I've got like 400 people who applied for 2 positions for these jobs in at the RV park in Dallas. But it's already got great management, so thankfully we don't have to change that. But this deal meets all these things. But you need great manager. If you have a bad manager, uh, it'll screw everything up. However, if you buy a good deal and you meet everything else and you find out that management isn't good, then you'll be able to replace them and it won't ruin the deal. But management has the ability to ruin a deal and ruin your sanity at the same time. So ensure that you can get a good manager. If you're buying a deal and you can't answer who's going to manage the deal or who the good management company is that will operate this deal effectively, it should be a red flag to you. Not that you can't figure it out, but don't don't settle for an okay deal in an average location without good management, good financing, good cash flow. Someone who wants to pay higher for it than you, better, good location, multiple exits, equity value, and opportunity. Because if you follow these deal requirements, you'll never lose money. But if you don't follow these deal requirements, your chances of losing money in real estate increase substantially. So I want to run through a deal with you guys and show you how this deal meets all these requirements. Opportunity and value. This is RV park. There's different opportunities with this, and there's different values with it. But uh, one of the main opportunities is us being able to see the seller financing terms that we got, which I'll cover when we get to financing. Insane seller financing terms, the ability to raise the rent, the ability to get rid of some expenses that are unneeded, raise the NOI, and create a ton of value price wise with this property over 5 years. So that's the opportunity and the value is seller financing and the ability to increase the income substantially, uh, make operations more efficient, get rid of some expenses that are unneeded, and in the process of doing that, uh, creating millions of dollars worth of value in the property. Right? If it was already maxed out, there wouldn't be any value other than the seller financing terms. Equity day one, we know that somebody will pay higher for this immediately. Right now, we've been offered by different investors, and this goes back to investor demand in number 6. But we have people who will pay us more for this property right now than we have it at. Multiple exits. Just like I was talking about, if we left the property as is today, didn't touch a dang thing, we would make 100% on our money, more than 100% on our money in 5 years. If we didn't touch anything or do anything to the property, we would make over 100% on our now. That's 25% a year. Now, uh, sorry, 20% a year. What we are going to do is we're going to add the value and seize the opportunity. So we have different exits. There's also many other things that we could do with it. We could put tiny homes there. We could redevelop it later. There's different ways to seize money on this. Location. The location of this property is great. It's insane. It's along I-20 highway. It's probably about 200 yards of highway frontage road. It's 20 minutes from Dallas, Texas. It's also very nice. It's a resort. You got palm trees, you got concrete, you got a pool, hot laundry on site, shower facility, all these things. Very nice. It's not some trashy place. And it's got a great location. It's 20 minutes from Dallas, Texas. Now, I couldn't have the park in the middle of Dallas, in the middle of downtown Dallas. You're not going to find these things there. So this is about as good of a location as it's going to get. And also, it's in the fastest growing county in Texas. I think there were over 200, there was an increase of over 210,000 people who moved to Coffin County last year. 210,000 people moved to Coffin County last year. It's the second fastest county in the United States. So there's a ton of things coming there. Also, there's new development coming. We got a brand new high quality gas station, service station, and then across the street from our park. Our residents are going to be able to go walk across the street, go get their eyes, go get drinks, go get snacks, go get beer, whatever they want. That's a huge value. You don't have to hop in their car. They don't have to go anywhere. You don't have to get on the highway, go drive a mile and a half down the road, turn, down a couple exits. They're literally going to walk across the street, go to the gas station, get some tacos, get some snacks, get some food, get some propane, whatever they need. That's And then we've also got 140 subdivision being built across the street as well. So the growth is being built around our park, also making the location that much better. Investor demand, like I just said, people want this deal. There's a tremendous amount of demand on this deal. People want it. People don't want it to close. They want to mess it up. They want to drop it so that they can come in and take this deal. It's a freaking steal of a deal. Cash flow. We have cash flow day one, uh, immediately. Day one, without doing anything, we have cash flow and at a good return. But as we see the opportunity and value, that cash flow is going to increase substantially. Great financing. We have a 0% interest seller financing loan on the property for 5 years. 0% interest. We also negotiated the at a price to where we'll cash flow. So every single dollar that we make towards uh, payments for the 60 is going to pay down our principal. We're going to pay down over probably about 1.55 million dollars worth of principal over 5 years. With 0% interest. Every dollar we make as a payment pays down our principal balance. By the time the 5 year balloon comes, we'll be at about 30-40% LTV. So again, multiple exits. We can sell it, refinance it. It'll be very easy to get a loan and get out of that currently. We'll be at like 30% LTV. Great financing, great management. I was a little nervous about the management, to be honest with you. I didn't have an answer for that immediately. But we went out, just because RV parks are different than like multifamily. If this was an apartment complex in Dallas, huh? You can't hear me? Here we go. Why blame myself? It's not me. It is this thing. I do what you tell me to do. Can you hear me? You can hear me? Can you hear me? All right. So RV parks are much different than multifamily. If this was an apartment complex, a 100-unit apartment complex, we could call Roscoe Property Management. We could call any of these big players and know that they instantly want to manage this deal in Dallas. But RV is different. There's not great and massive, a lot of choices for RV park management to choose from. We started interviewing a lot of them and wasn't really satisfied with the business plan or the business model, but we have great on-site management. So we went out, we toured the property, we met with the current on-site manager, we met with the current uh, maintenance supervisor who oversees everything on site, and it was such a relief to know that we have good management, good maintenance already there, and that's what those applications were for. But like I said, I have like 400 applications to choose from. So all I have to do is set up interviews with 400 people, which I wasn't looking forward to, but I could have easily found someone who would meet those roles just due to the demand for this job in this great location. So, any other questions? That's it for today. Deal requirements. Don't mess these rules, and you'll never go wrong investing in real estate. By the way, let's see here. April 6th, we're going to be having another virtual workshop. It's free to attend. We're going to be talking about this type of stuff, commercial real estate investing. I'm going to be with you guys for an all-day event. We're going to find deals, analyze deals, and we're going to make sure that you leave that virtual event with the confidence and knowledge that you need in order to be able to go out in your market and find deals that meet these deal requirements. If you have any questions, reach out. We're here to help, and we'll see you next week.